You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome back to the Infinite Banking Mastery Podcast. So what happens if you've made a plan to start your policy, everything is going great, you get your underwriting approval, and then all of a sudden something has come up that's going to keep you from being able to fund your whole life policy at the full level that you intended, the amount you had fully decided on starting with? Well, don't worry, there are lots of options to get you started if something like this happens. I thought this would be a good topic because I think it causes a lot of unnecessary anxiety for people when life happens and we have to pivot. So here's the scenario. You have made a plan to start your whole life policy. You've done your research, you've had the important decision-making conversations, you've gotten your underwriting approval, which, by the way, is exciting because that's a big step. Can't proceed without an approval. And you had a premium amount in mind, an amount you felt really good about. And then life happened. Something came up. And now you're looking at that premium and thinking, I don't think I can do this right now. Not at that level. Maybe it's an unexpected expense. Maybe your income shifted. Maybe you just got a little bit scared. And what I want to point out is you have options, more options than you probably realize. And in most cases, there is absolutely a way to get started, even when the full premium you originally planned isn't available to you right now. Before I get into the specific options, I want to mention something that I see happen sometimes, and it breaks my heart a little bit every time. Someone goes through the whole process, they learn about infinite banking, they do all the research, get super excited, they go through underwriting, which isn't always a walk in the park. They get approved, and then something shifts in their financial picture. And instead of pivoting and finding a workable solution, they will pause or wait. And sometimes they tell themselves they'll start when things settle down. And then a year goes by, and then 2 years go by. And then they find themselves wishing they had just started at a lower amount because now they've lost a year or two of compounding growth that they can never get back. So just don't let the perfect funding amount get in the way of actually getting started. A policy funded at a lower level than you originally planned is so much more powerful than a policy that never gets started. Or a policy that was delayed for 5 years because the stars never aligned. Because the most important ingredient in this whole strategy isn't the premium amount, it's time. And every day you wait is a day of growth that you cannot recapture. Okay, with that said, let's talk about what your actual options are, because there are quite a few. To make sense of the options I'm about to walk you through, it helps to have a quick understanding of how a premium for infinite banking policy is structured, because it's not just one number, it's really two parts working together. The first part is your base premium. This is the foundational part of your policy. I know I've talked about this a lot. It's what keeps your policy in force and active. It's the non-negotiable piece in the sense that if you're going to have a policy, this is the part that has to be paid. The second part is your paid-up additions, or PUAs. This is the piece that's really doing the heavy lifting when it comes to cash value growth in an infinite banking design. When a policy is designed well for this concept, the paid-up additions are structured to maximize cash value growth while keeping the policy efficient and income tax-free. This is the part of your premium that turbocharges the strategy. Now, the reason I explain both pieces is because the options you have when you can't fund the full premium often involve adjusting how and when you fund those two parts, rather than just cutting everything in half. And that distinction matters. So let's go through the options one by one. Option 1, start with monthly premiums for both the base and paid-up additions. If you had originally planned to fund your policy annually, meaning you were going to send in one payment per year for the full amount, one of the simplest pivots is to switch that to a monthly payment. Your premium amount stays the same overall, but instead of coming up with the full annual amount right now, you're breaking it into 12 smaller payments. Now, I will say that there is a slight small discount for paying annually. And so if you do switch to monthly, that would change a little bit, but it's really a very minimal discount, at least with the companies that I work with. So for some people, this is all it takes to make the premium feel manageable again. The total you're putting in over the course of the year is the same, you're just spreading it out. Option 2, fund the base premium monthly and the paid-up additions annually. This is an option I use with clients fairly often. You pay your base premium on a monthly basis, which keeps the policy active and enforced throughout the year. And then you fund the paid-up additions when you have the funds available. Something important to understand about this setup is when your paid-up additions are in annual mode, you have the flexibility to send funds toward them in any amount at any time throughout the year. You don't have to send the full payment at once. If money comes in mid-year and you want to apply it towards your paid-up additions, you can. And whatever amount you've accumulated in paid-up additions becomes basically fully available as cash value as soon as those funds are paid in. Now, this differs with different companies. With some companies, you will have a fee on the paid-up additions, or you may have a fee on some of the paid-up additions, depending on the ratio between the base and paid-up additions premiums. So this may make a slight difference in how much cash value is available after those paid-up additions have been paid in. Option 3, fund the base premium and the paid-up additions quarterly or semi-annually. Or you can fund the base monthly or annually and the paid-up additions quarterly or semi-annually. Quarterly or semi-annual paid-up additions funding can fit nicely into a budget that has some variability. For example, if you're a business owner or if your income has some seasonal fluctuation, you know that 4 times a year or twice a year, you're going to sit down and send in your paid-up additions payment. Option 4, you can start with an annual base premium and fund the paid-up additions throughout the year. I've worked recently with 2 clients who both ran into a similar situation in slightly different ways. The first client had fully planned to start her policy with a $20,000 annual premium. She was ready, she was excited, and then right around the time she was about to get started, she got nervous. Not because of any specific expense or sudden lack of belief in IBC. She is a real estate agent and was concerned about income in the year ahead. So she called me and said she wanted to drop her premium all the way down to $8,000 a year. And of course, I didn't argue with her or push back. Instead, I said, let's talk through your options. And what we landed on was that she would start with the $8,000 and then take the rest of the year to fund the remaining $12,000 in stages as she felt comfortable. And so that's exactly what she did. Halfway through the year, her confidence had returned and she funded the $12,000 difference without a second thought. She ended up at the full $20,000 for the year, and she felt great about her policy and every single step of that decision because she was in control of the pace. The second client was in a different situation. She had a large, specific, and unexpected expense come up. She had planned to fund her full annual premium right at the start, but with this expense on the horizon, she wasn't sure she wanted to commit all of that cash up front. Now, one thing I shared with her is that if she had funded the full premium, including her paid-up additions in annual mode, that paid-up additions amount would have been accessible to her almost immediately as a policy loan. She could have accessed those funds for the very expense she was concerned about. But she wasn't quite there in terms of her comfort level with taking a policy loan so quickly after starting, and that's okay. So she decided to pay the base premium monthly and take the year to fund the paid-up additions, and that was the right decision for her at that moment, which was just fine. Because at the end of the day, that's what I care about most. I want you to feel great about your decision. I want you to be excited when premium time comes, not anxious. I want you to feel like this is working for you because that is absolutely the goal. Now, I do want to take a few minutes to talk about something that comes up whenever we're adjusting funding amounts, and that's the Modified Endowment Contract, or MEC. I've done a deeper episode on MECs before, so I won't spend too much time here, but I want to give you enough to understand why this matters when you're making funding decisions. As a reminder, a MEC is what happens when you put too much money into a life insurance policy relative to its death benefit within a certain time period. Once a policy becomes a MEC, it loses some of its tax-favored treatment. Specifically, loans and withdrawals can become taxable, and you can face penalties if you access funds before age 59 and a half. And once a policy becomes a MEC, it cannot be undone. Now, the connection to today's topic is that the amount you fund in your first policy year can affect your MEC limits going forward. If you end up funding less than what was originally illustrated in your first year, that lower amount will affect your MEC ceiling and can actually become your new MEC ceiling, meaning that the policy is calibrated around the lower funding level, and if you try to go above that in future years, you run the risk of causing a MEC. I'm not saying this to scare you. I'm saying it because it's important to understand and to talk through with your practitioner before you make any changes. The chief actuary at the primary company I write policies through shared with me that each premium payment resets the MEC test. So this isn't something you set once and never think about again. It's something to stay aware of as you fund and grow your policy over time. Now, the rules around this can vary between companies. I've written policies with 3 of the top mutual companies, and while the basics are generally consistent, the specifics can differ. This is another reason why working with a qualified IBC practitioner matters, someone who knows the particular company and product that you're in and can walk through the implications of any funding change before you make it. And before I close today, I want to leave you with one piece of advice that I give to almost every client I work with, and I think it's one of the most important things. It is to start at the higher end of your budget. I know that sounds counterintuitive when we've just spent this whole episode talking about what to do when you can't fund the full amount, but here's why it matters so much. When it comes to a whole life policy for IBC, you have the flexibility to decrease your premium going forward. If life throws something at you next year, an unexpected expense, an income change, whatever it might be, you can easily reduce the premium. You have options. But you cannot go up. Once your policy is issued, you cannot increase your premium, or I should say you should not increase your premium because some companies will allow you to fund higher than your starting funding amount. So if you're deciding between 2 numbers and you're not sure which way to go, I almost always say to start at the higher end of your budget, fund at the top of your comfort zone because you can always bring it down later if you need to. That's super easy. But you cannot or should not fund higher in the years ahead, and you cannot go back and recapture the growth that you missed. I will say also that each person, policy, and situation is unique, and so I don't want to blanket statement this for everyone, but unless we've worked through specifics for you, I would say this is safe advice to follow. Just keep in mind that you are making a decision today that your future self either gets to benefit from or has to live with. Give your future self the gift of starting as strong as you can. Oh, and one more thing I meant to say is that if you're working with someone and they're telling you that you have all the flexibility in the world, they can go much higher, you can go much lower, most likely they're talking about a universal life policy, and those we feel are just much too dangerous for the infinite banking concept. A true IBC practitioner will guide you towards a whole life contract. So if you are in the situation right now, excited about starting, but battling with what you can afford, and you would like to work together, reach out to me. This is exactly what I help clients navigate every single day. We can look at your specific situation, talk through your options, and find an approach that feels right and works for your life. You can reach me at Valerie@alphaomegawealth.com. I would love to hear from you. And for those of you who are just beginning to explore infinite banking and are wondering whether this is something that could work for your family, same invitation. Let's talk. We can talk about your current financial picture, your goals, your concerns, and we can get more in depth on the infinite banking concept. Just reach out. I hope this episode gave you some clarity and, most importantly, some peace of mind. Whatever your situation is, there is almost always a path forward, and I'm here to help you find it. I hope you have a wonderful week, and I will talk to you next time on Infinite Banking Mastery.
This is thepodcastfactory.com.